You found Michigan's retirement coach, Mike Douglas.
A common belief about retirement investing is that once you stop working, you should get out of the stock market and shift your focus entirely to protecting everything you've saved. But the reality definitely is more complicated than just completely avoiding stocks and creating risks of its own. Retirement isn't just about preserving assets, it's about generating income, managing inflation, and making sure your money lasts. Today, we're exploring whether retirees should still own stocks, the role of stocks in a retirement portfolio, and how to think about balancing your portfolio for growth and protection. Retirement doesn't eliminate the need for growth. In fact, you may realize that growth becomes even more important. Retirement can last you 20, 30, or 40 or more years. A portfolio built solely for preservation may struggle to keep pace with rising expenses. Life's getting more and more expensive, and if we strictly sit in cash, we can't keep up. Many retirees underestimate how inflation can impact their purchasing power over time. Growth is often needed to help maintain a retiree's standard of living through retirement. The goal isn't necessarily to maximize returns. It's about maintaining your long-term purchasing power. Don't fall behind inflation. Portfolios designed only for safety can sometimes create new risks later in retirement. That's right, safety can create a risk down the road. So if retirees still need growth, the next obvious question is why? The answer often comes back to one simple thing, the biggest challenges that retirees face, and that's inflation. Inflation may not seem significant year to year. Even modest inflation can have a major impact over a multi-decade retirement. So many times when we sit down with people, they are blown away when we show them how much a 2% inflation can drastically increase their expenses over their life. Inflation doesn't just increase little things or big things. It increases the cost of everyday expenses all the time, year over year. Retirees often experience decades of rising healthcare costs, housing, and living costs. A retirement that lasts 25 to 30 years will likely experience several different economic environments. Cash can feel safe, but oftentimes it makes it so you lose your purchasing power during inflationary periods. Just think back a couple years ago when inflation went really high and interest rates spike and you're living on the same amount of money, you can't buy as much. Things felt tight, things felt difficult. And then if you noticed, inflation went up, and as it started coming down, prices didn't come down with it. They just didn't go up quite as quickly. Stocks historically have helped investors keep pace with inflation over long periods. Retirement planning isn't just about protecting principal, it's about protecting your spending power. So if retirees need growth to address inflation, should they simply maintain their standard stock allocation they had while they were working? Not necessarily. The question isn't, should retirees own stock? It's really about how much stock exposure is appropriate. Owning stocks and being heavily invested in stocks are two very different things. Stock allocation should reflect income needs, risk tolerance, and retirement goals. It's more complicated than do I or don't I. Some retirees really need to get some more growth. They need that higher growth potential, while yet some others can prioritize stability and income. The appropriate allocation for one person is not the same as the other. Every family is different. Every portfolio is different. Your needs are different than mine, and we need to build plans accordingly. Retirement income sources like Social Security, pensions, annuities, they also influence your investment decisions. Asset allocation should be driven by a really comprehensive plan, a holistic plan, which is a term that everybody says, but very few actually do. You want a whole plan that talks about your income, your investments, your risk, taxes, inflation, long-term care, Medicare, all these things together, not relying on some rule of thumb saying take 4% and you should be okay. Retirement investing becomes more personal and individualized now than ever before. But determining how much stock exposure makes sense for your family is only part of the equation. Next, you need to decide how stocks fit into your overall income strategy. Stocks aren't always used solely for growth. They also can play a pretty heavy role in generating retirement income. A lot of times retirees will incorporate dividend-paying stocks or preferred stocks into their overall retirement income strategy. Dividend-paying companies provide a stream of income while still offering some growth potential. They also aren't guaranteed income sources, and they still carry market risk. A company can shut off their dividend. Ford did that a few years ago. Ford, a long-term dividend company, decided to try and grow their stock price. So they shut off the dividend. And it caused such an uproar that not too long after that, they went right back to where they were paying out dividends. Stocks really can complement other retirement income sources. Growth and income are not mutually exclusive objectives, but when you build a retirement portfolio, it often requires balancing my income needs today with growth needs for tomorrow. That's why we say a successful strategy typically focuses on the overall portfolio rather than any single investment category. The stock market doesn't have to be an all or nothing decision for retirement. For most people, it's just figuring out balance between growth, income, and protection base for your income needs and your goals. So to recap, here's your action items. Review your current stock allocation. Evaluate if your portfolio has enough growth potential to address inflation. Determine how much income will come from guaranteed sources versus investments. How much can I really bank on versus how much am I counting on the market to give me? Assess whether your investment strategy matches your risk tolerance. Is it who you are today? Focus on your overall retirement plan rather than just short-term market headlines, and review your portfolio periodically to ensure that it remains aligned with your goals. Again, your goals, not the financial industry, not some big box firm or the financial advisor. Make sure it aligns with your goals. Retirement doesn't automatically mean getting out of the stock market. For many, it's just simply maintaining some exposure to fight inflation. They also want to support long-term growth and strengthen the stability and sustainability of your retirement plan. If you need help determining how stocks fit into your overall strategy, reach out to us. You can go to our website, michigansretirementcoach.com, or click on the link posted here.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit michigansretirementcoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.